Hey folks, welcome to a product review at Finominal. Today we're going to look at Neuberger Berman's long short fund, which trades under the ticker NLSIX. Now the fund is a long short equity fund, so its portfolio is comprised of around 100 long positions and 40 short positions. And that kind of results currently in a net exposure of around 40%. Now, the fund manages around $8 billion, so that's quite successful, and aims, like almost all long-short equity funds, to provide a limited downside but an attractive participation in the upside. So let's see if that fund has achieved that. And we're going to kick off with a simple benchmarking exercise. If we look at the fact sheet of NLSIX, we do see that the S&P 500 is shown and the HFX equity hedge fund index. And but we can see over here that the S&P 500 is a poor benchmark, simply because it has vastly outperformed NLSIX since 2012. Our auto-suggested benchmark is the S&P Target Risk Conservative Index, which is a equity bond portfolio. And we can see that looks a lot more similar to Neuberger Berman's product. We can kind of refine this, right, by adding another target risk growth index here from S&P 500. And I think we will see that the long short equity fund lies, well, yes, exactly between both indices. So you can see the S&P 500 is kind of a poor choice, but these cross-asset equity bond portfolios are much better benchmarks. Now, let's move on in terms of what has been driving the risk and returns of NLSIX. And we're going to do that via a returns-based factor exposure analysis. Now, just eyeballing the factor betas to major asset classes highlights that NLSIX had this kind of consistent exposure to the stock market, which you expect for a long short equity fund, right? And that range between 0.6 and 0.3 over time. Well, there is no other exposure to bonds, commodities, or the US dollar, as expected. What's more interesting is if you look at the exposure to equity factors like value momentum, that there is no consistent exposure to those. And either that indicates that Neuberger Berman is having a very dynamic factor allocation model, which I doubt, or simply that they don't care about factor investing, which is more likely. Now, let's see if that helped Neuberger Berman in terms of creating alpha and creating value for its investors. Now here we see that effectively most of the return over the last, well, more than 10 years, right, since 2012, can be explained by simple exposure to the stock market. We can also see that the exposure to equity factors, right, or the contribution of equity factors has been minimal, as we saw in the factor exposure analysis. But unfortunately, we also see that the alpha contribution has been consistently negative. And this might simply be a function of the high fees, which are 1.27% for the share class. Now, the reasons why someone allocates to long short equity hedge funds is, as mentioned, either is get that reduced downside and a little bit more upside, or have a structure that is a little bit less correlated to the stock market. So let's evaluate the diversification potential of NLSIX. And what we see over here is that the correlation to the stock market over the last 13 years has been 0.9. And now that, of course, indicates very little diversification benefits. We also see that the upside beta to the S&P 500 is lower than the downside beta, which is not favorable. And we can see that if you would have added an allocation to this fund to portfolio comprised of the S&P 500, your Sharpe ratio would have increased, yes, but this is marginal. So there are no diversification funds from this product. Now, if you're already paying 1.27%, then you do want a fund that is unique and that is offering something special. Now, currently, we're seeing that the correlation to the stock market, was 0.9, that the upside beta was lower than the downside beta, so that's all not great. And so one of the things I've done is, in terms of ask the question, can I replicate this fund easily? And if yes, that's not good. If not, right, then it might be unique. So I've created a simple portfolio of the S&P 500 with a 40% allocation and cash with a 60% allocation. And if we compare the performance of NLSIX to this very simple replication portfolio, we actually see that since 2012, the performance was almost identical. And that naturally confirms, right, that, or if we rephrase the question, is this fund offering anything unique? The short answer and the long answer is no. We can look at the Sharpe ratio, for example, right? So the Sharpe ratio of NLSIX has been 0.96, which is high, right? But it's lower than the replication portfolio with 101. And of course, paying 1.27% versus paying 12 basis points, right, doesn't make this easier. And so this kind of concludes our analysis of Neuberger Berman's long short fund. As mentioned, it's a long short equity fund, right, that aims to provide more participation on the upside and downside, but it hasn't done so. And paying 1.27% per annum for something that can be replicated just with equities and cash is not particularly sound, and there's better funds out there from a diversification perspective. Hope that helps. Have a nice day.